All right, traders, this is Blake Morrow. You were listening to the Lunch Money webinar. I hope everybody's having a great trading session and happy day before Christmas Eve. Trading day is Wednesday, December 23rd, and hope everybody's having a great trading session. A real quick overview, or not really overview, kind of a recap of what's happening in the markets. Obviously, we're seeing some dollar strength. We've got the euro taking a little bit of a tumble at the moment, and let's go over to the euro dollar really quick. And as the euro dollar has been falling, I took my short off the table earlier this morning, and you can see a really big rejection here at the 110 level overnight. Okay, and this is yesterday. Actually, we were coming right into that. We broke through support, which came in at 109, and now we are approaching some. This is probably going to be fairly decent support intraday. I don't want to say we can't go any further, but we're here at the 618 retracement, and this is, as you guys know, the golden fib is the 618. That's why I always have it highlighted in red. It tends to be the most highly touched, pivoted on, reversed at, consolidation at fib level of all the fibs that I've been following for the last 20 years. So it doesn't surprise me, or wouldn't surprise me if we stalled here, especially on a holiday like holiday trading like we have today. It's a highly trafficked area. You can see from previous hourlies we've had a lot of trouble here because that was a 38% retracement. If you guys don't remember this from yesterday, it's a nice little 38% retracement that really rejected price multiple times. Boom, 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 boom. Broke out. Obviously, we're back at that high traffic area again today, and it happens to be at a 618, and it happens to be the day before Christmas Eve, and it happens to be less liquidity, and it happens to be a period where you start getting a little oversold, where you're probably going to consolidate, if not bounce. All right, so now we really, I was just looking at the euro, obviously, and I want to do a little training today for a gentleman named Eric. Eric is in our chat room. I want to talk to you guys a little bit about Eric. Okay, so Eric is one of those traders. He retweeted this tweet. If you go see who retweeted the tweet about about today's webinar, he's a newer trader, and but he's great. He's a really neat guy, and myself and everybody else that is in our chat room that we communicate in, talk about trading. He's been a real great addition because he interacts a lot. He likes to talk about his wins. Wait, hold on. My wife brought me something. Shoot, where'd it go? Oh yeah, hold on. Stand by. So he likes to talk about his wins, and then he, also he wants to talk about what he did wrong as well. And so, that's what's really important about trading, is dissecting what you did wrong and incorrectly, and how you can make it better. The gains are great. You learn how to replicate those, but when you have losses, you want to figure out how to avoid those. When you've been trading for 20 years, or you've been in the markets for 20 plus years, like myself, a lot of it becomes second nature, and you stop dissecting as much, and you're really more or less in a flow. Like a lot of stuff that I do when I trade the markets is kind of like when I drive. It's all second nature. I don't really think about looking over my left shoulder as I'm, or looking in the, rearview mirror as I'm looking to switch lanes, because I kind of know where every car is at as I've been monitoring as I'm driving down the road, and everything's, it's like walking, it's driving and walking. It's just all second nature. Same with trading. Once you've been doing it for so many years, there are, obviously periods of time, especially when you take a good week or two off of trading, where you need to reacclimate yourself to the markets, and you start being careful and making sure that your processes are correct. But a lot of stuff that we do, especially those of us that have a little bit more experience, we do a lot of things that are, it seems like second nature. But when you're newer in the markets, it's not second nature, and it's you're learning these skills. And one of the things that I think I'm very proficient in as a trader is minimizing my losses and maximizing my gains. There are times that I will get myself upside down in a position, take a loss, and it's like, and it's somewhat, for even the size that I might be trading, it might be a sizable loss, but it's all it seems sizable when you look at pips, but really it's all manageable because of risk associated with that trade. So, everything that you trade, it shouldn't be based on pip or pip movement, which a lot. That's you. When somebody tells you and they think they know how to trade and they tell you how to, this is how it should be done. When anybody only captures, they only talk about pip movement. They don't talk about the risk associated with the trade. That tells you that they're a very green trader. They don't really know about the markets, because when you're trading currencies, not everything moves. A 10 pip move in the euro dollar does not equate to 10 pips in the pound New Zealand, nor in the euro pound, nor in the, everything that you're doing is based on risks associated with the size of the position that you have on versus where your expected stops or limits are. Does that make sense? All right, so for example, if I trade the euro dollar, right now and I buy it right at this moment in time at 108.72, okay? I take a position here, I take a stab, and I say, this is it, I want to get long here. Well, if it moves 10 pips and I go, ooh, I made 10 pips. Well, 10 pips to me, on 10 lots, I might have made it, I might have made $100. Ooh, I made $100. Great. But in relation to my account, like let's say I've got a $100,000 account, I make $100, I made 0.01%. Big deal, Same thing as if I lose 10 pips and I lose 0.01%, I lose $100. Big deal. It's not a big deal. Okay. But somebody trading the euro dollar and trading, for 10 pips, if they have a $10,000 account and they traded 10 lots, that's a 1% move. That's a big deal. But what makes it a bigger deal is if you lose 10 pips or you lose 20 pips, now you just lost 2% of your account. So how in God's name do you expect to make 2% in your account in one trade? It's much more difficult. That's why everything that we do is controlled by risk associated with, how big of a position we have versus the size of account that we have. So like that's why whenever people say, well, Blake, how much are you risking in that trade? It doesn't matter how much I'm risking in the trade, pip-wise, or, when I should have said, how much are you risking? If I say I'm risking 10 pips or I'm risking 100 pips, that may be completely different to what you're doing, because your account may not be, and I'm just using an example because it's really no business how big of account I trade. But if I'm trading a $100,000 account or a $500,000 account, you might be trading a $5,000 account, or maybe you're trading a $5 million account. Our definition of risk in the market is going to be completely different. If I've got $100,000 in my account and you've got $1,000 in your account, you're trading micro lots and I'm trading standard lots. Yeah, I could possibly swing a $500 loss, and it doesn't, I don't really think about it too much, risking 0.5%. But if you're trading a $1,000 account, and you have too many lots, and you end up losing $50. Well, you just lost 5% of your account. That's a big deal, and there's a big difference in how you define risk and I define risk. That's why when people say, well, where's your stop? It doesn't really matter. Because it matters, but the way again, what I'm risking versus what you're risking may be two totally different things. That's why your stop is important, but what's more important is how big of a size of a position you have in relation to where that stop is versus the size of your account. That's ultimately most important. And that's one thing that people in the markets don't talk enough about. That's something that, here when we're talking on the webinar, sometimes I lose sight of it, because we speak 3.5 hours a day, just you and I, me talking, you guys asking questions, you listening in. That's 3.5 hours of my day. A lot of time I get short-sighted. I don't talk enough about risk. I should talk more about risk, because we always talk about like, hey, well, here's the euro dollar. I'm looking to put in my stop real close to here. I think your risk is negligible. You might be only risking about 15 pips here, and your reward might be a nice bounce back up to 109.20. But I talk a lot about that, but we should really be talking about, okay, hey, my stop is only about, 10 or 15 pips away. I really don't think you should be risking more than 1/4% of your account here. But your reward here is if it does get a nice little bounce, you might make 0.5%. See, everything that we do is all about risk versus reward, managing risk, and making sure your risk is within your parameters. So your first question you have to ask yourself is, what is appropriate risk for you? Because I don't know the answer to that question. I don't know the answer to that question. Appropriate risk for me per trade is somewhere around 1/4 to 0.5%, depending on how confident I feel in the move that I'm going to participate in. Am I going counter trend? I'm going with the trend. Where's my comfort zone? But that doesn't mean 1/4% or 0.5% is your comfort zone as well. Excuse me 1 second. Yeah. One of the things I figured I was going to have a problem with, because if you guys have been, normally listening, you guys know that I just haven't been feeling 100% recently. So I am coughing a little bit from time to time, and I will have to take a break in a few minutes to go get some water. But as I'm almost out. Okay, so let's talk about, in this case, the euro dollar. And note we did our analysis already. If you came in a little bit late, we said, hey, we had trend line resistance here at 109.85, 110. We knew that was major resistance. We had a pullback. We had a pullback here. There was a 38% retracement, boom, and then once it broke, it gave us that full extension towards 110 yesterday. A lot of us got short because, frankly, when you're looking here, you have to ask yourself, okay, and let's go back to yesterday, like, where's your risk? Because before you can talk about where I'm going to put my limit and where I'm going to take my, I'm going to look for profits, you have to ask yourself, where is the risk? The risk, that's always number one question you should ask yourself. Anytime before you get in the market, before you actually press the button, you say, I am going to buy or short that security, you should ask yourself, what is my risk? Now, there's two ways I define risk. I define risk as a hard stop. Okay, that's where, excuse my language, if shit hits the fan and I have to get out, I get physically stopped out of the market, that's risk number one. Risk number two is where I'm going to have more of a mental stop. So like for me, whenever I take a trade, I'll put in a hard stop. Like, let me grab a pen here. I'll put in a hard stop, like I get short the euro dollar, boom, hard stop. Bam, okay, hard stop goes above resistance. Great. Now, I sure as hell don't expect to get out here, and very rarely do I get stopped out. Most of you guys know I don't get stopped out. Why? Because my stops are usually wide. Why are they so wide? They're there for account protection. If I get stopped out because I'm sitting here shorting the euro dollar and all of a sudden the ECB says, hey, we're done doing quantitative easing. They wouldn't have done this yesterday, but hey, we're done doing quantitative easing. And matter of fact, we are going to reduce the amount of asset purchases that we're going to make going into 2016. Well, you know what? Probably within about I don't know, 3 or 4 minutes, we'd be trading up at 112, and I would have to get stopped out. But at least I've preserved my account by putting in a stop, putting in a hard stop. So number one, your ultimate risk is where you put your hard stop, and somewhere around there, because you have to assume there's going to be some slippage. All right. So you get stopped out. Boom. Great. That preserved your account. That's risk number one. Risk number two, and where is more in line with where I physically will manually exit a trade, is when it gets to a point where I think is unbearable. Like in this case, I was looking at it yesterday going, okay, if we get above 110, I don't want to be short anymore. Or I don't want to be short the euro dollar at 110. Now, I personally didn't trade this too well, but we were talking about this trade yesterday afternoon when we were approaching the 110 level yesterday, because look, this is, you got your trend line coming in. This is a 786 retracement. It all came in right around the 110 level. So we knew that if it got above 110, that's where I physically, or I personally would have felt very uncomfortable being short the euro dollar, and I know I'd have to physically remove myself from that trade. So I'd have to manually exit that trade and take a loss. Okay, so that's number one. You go, all right, you got your physical stop, then you have what I call more of a mental stop. Now, here's could be the differentiating factor that makes you a really profitable trader versus a trader that ends up spinning his or her wheels around, for years and finally figuring out, man, this is really tough. I'm going to go do something else. Okay, is having the fortitude, the internal fortitude and discipline of actually physically getting yourself out of a trade. Many of you, and I'm not pointing it out anybody in particular, and I'll tell you myself, especially when I first started trading the markets, I had a very difficult time taking a loss. Because when I exited the market and I took a loss, I understood that when I took a loss, that was a loss. Like it's not done until I get out, and then I get out, I take that loss. That is money that has been subtracted from my account. So I had a hard time taking a loss because it's like I don't lose. I don't want to lose. I don't want to do it. I don't want to lose money, so I just want to do it. Well, see, if you can't get over that, and you can't get over the fact that you will take losses, and you'll probably take losses more often than you want, but you have to get over the fact that you will be wrong. And I know I'm wrong quite a bit, but I know when to cut the cord of a trade, or as Kenny Rogers would say in his song, you have to know when to fold them, know when to hold them. Oh my God, I'm going to start singing again. But you have to know when to get out. You have to know when to say, all right, that trade's not working for me. I have to take a loss. I have to fold that hand, if you will, if you're playing poker. Okay. And so above 110, that's your risk. Now the question that I get, and I got from Eric yesterday, is like, well, how do you do a limit? How do you do a limit? All right. Now limits are tough because in a limit order, you have to ask yourself, well, first of all, it's hard to gauge, especially if you're really pinpointing your entry. It's hard to really gauge where a limit should be because you can't really draw. Like I draw fibs and I draw extensions, okay, and I like them to coincide with other technical factors to figure out where a limit order should be, right? So in this case, like if I'm shorting the euro up here in the 109.70s and I know my risk is above 110, what I have to do is figure out, is it possible from where I enter the market that I can at least make double of where my stop is? So, if you're doing the math here, you go, okay, well, if I'm going to short the euro dollar as we approach 109.70, and I'm risking by the time I get out, it's about 110.10, so I'm risking about 40 pips. Is it possible that I can make 80 pips on the way back down? Is it even feasible? Like in this case, we see a lot of support at the 109. You say, well, if I short it at 70, and I've got 40 pips in risk, I've got 70 pips in gain, that's close to a 1-to-2 risk-reward ratio, right? That's close to a 1-to-2 risk-reward ratio. So by taking a trade yesterday here at 109.70 and saying, okay, I got 40 pips in risk and 70 pips in possible gain, that already justifies, in my opinion, it already justifies you taking a trade if you want to, because you have appropriate risk reward. You want to make sure it's always, at least 1 to 1.5, but closer to 1 to 2 is better. Obviously, if you can get risk reward 1 to 3 or 1 to 4 or 1 to 10, that's great. Those trades are more difficult to come by, and you obviously have to be way more disciplined in order to find them. Okay, so in this situation where you got the euro dollar, and you go, okay, well, I'm going to risk above 110.10, and then I'm looking to gain, up to 109. Okay, so it finally makes it down to 109 in Asian trade. So we get down to 109, and A, you could, get out of your position, or B, you can decide to ride this out a little further. So now that you've fortified a high and you obviously have a low, you can go from low to high, and you can start calculating where a fib level might coincide with a previous support, current resistance, and in this case, you have your 618. So, when you're risking 40 pips to make not only 70 to make 100 pips, because you shorted at 109.70, it's now at 108.70, you risk 40 to make 100. That's more than a 2-to-1 risk-reward ratio. That's appropriate. Now, here's the thing. I knew that we were going into the holiday week. That's why, when it got to 109, I'm like, I'll just go ahead and get out. But, you obviously have to take those things into consideration. It's a holiday. It's going to get quiet. Chances are we're just going to be going sideways for the next 24 hours. We might get a little flooding up and down, but realistically, it's going to be, pretty quiet. So if it wasn't like, let's say it wasn't Christmas week, if it wasn't Christmas week, you might be actually looking for a greater target, which in my opinion would be more like a 127% extension or maybe 161% extension. And that's where I really try to make, my targets. Because not only do I want to make sure I pinpoint an entry, but I want to make sure that I have some sort of extension. And like, you know as well as I do, the great thing about markets is breakouts are meant to be faded. It's one of the things that a lot of beginning traders don't understand, but those of us that have been around for a little bit know that breakouts, and they tend to get faded quite a bit. So in this case, like 127% extension is a realistic target for me, because once you break through this support, boom, boom, everybody gets freaked out, everybody gets stopped out, and as they're getting stopped out, you turn around and go, bam, you take your profit off the table and you wait for a bounce back, and then, for eventual move down here. But I always like to target extensions, 127%, 161%. But the only way you can ever get to those extensions is making sure that you pinpoint your entries and you become very efficient in pinpointing good places. So let's, I'm gonna put you guys on hold for a second. Well, actually for a few minutes, because I need to go grab some water. I want to come back and I want to talk about another trade, which was very similar to this yesterday, that a lot of you guys participated in, which was the euro pound. So when I get back, we're going to talk about the euro pound. We're going to talk about, I already got out of it because, again, it's Christmas, so I took my profits a little early this morning, but still, we're going to talk about, rules for entry again, utilizing, trend lines, being able to manage risk, knowing where your stops are at, and knowing what your risk is, and then, making sure that you have a limit that can be calculated based on, a pullback, and you have enough, little smaller risk and a limit that's appropriate enough for the risk that you're willing to take. And then I'm going to take some questions. So glad you guys and gals are here. Happy Wednesday. Happy day before Christmas Eve. Don't go anywhere. I'll be back in just a few minutes. I'm going to go grab some water. Thanks. All right, traders, this is Blake Morrow. You were listening to the Lunch Money webinar. So let's continue on talking about, and I'm going to answer some questions, because this is a really great question. Actually, even before I go into another example, Dan has this really great comment. So his comment is, the hardest thing for me, Blake, was the losses, but closing out before it closed me out. I would just say the hell with it and close it out before my stop got hit, only to have my stop hold and the trade come all the way back in the profit. So why is that such a big issue, Dan, for a lot of people, not just you, and it had been in the past for me and whatever else. One of the that would be really tough, because it would really impact your confidence, because you're like, damn it, I had it, I knew it, and it worked out in my favor. It would have worked out in my favor, but I got myself out of the trade anyway. Do you know, and I'm going to ask, and I know everybody's sitting here that listening in right now can relate to that and go, God, that happens to me too. It sucks. It's such an, So, what do you think can help give you the confidence to sit in a trade, even though it might be working against you, and still have the confidence to stay in that trade? What do you think? What do you think? I'm asking not just you, Dan. I'm asking anybody. So you go, okay, well, I got in this trade. I know it's getting close to my stop. I should, technically I need to get out, but what gives you the confidence to stay in? Eric said the experience of staying in. No, no, it's not just the experience. That experience and your gut, actually, believe it or not, does matter. I think my gut, obviously it gets louder and bigger as years go on, and I don't think that has anything to do with my trading. I think that has more to do with hamburgers and French fries. But I tend to listen to my gut a little bit more. But what else? Cindy, the trend is still in play. Good. What else? How about the macro picture? How about the macro picture, the macro backdrop? Or, as Cindy would say, the trend is still in play. In my opinion, the reasons why really matter. And that's why people that only do technical analysis, and I always tell people this, if you held a gun to my head and you said, listen, you could just, listen to the radio and trade technically, or, you read all you want, but you got to trade blind without looking at charts, and you trade, from a more of a macro point of view. I would say give me charts any day of the week, because price doesn't lie. Price doesn't lie. So I just trade technicals. But one of the things that gives me the confidence to stay in a trade is because I know why it's happening. Knowing the whys. Yeah, Joe would say like the fundamentals, right? The fundamentals, and in the currency market, it'd be the fundamentals or the macro backdrop and the reason why something's happening. Like, I have all the confidence in the world to sit in the euro short. Like, when I see the euro coming up in my face at 110, it doesn't freak me out, because I know eventually it's going back to 105. Until something changes and the ECB starts tightening monetary policy somehow, the euro is going to go down eventually. It may go up in my face a little bit, but it's probably going to go down over time. Having that backdrop constantly in my viewpoint, or in my mind, helps me have the confidence to stay in. The longer term trends, as as Cindy pointed out, that's important. If I can look at the euro dollar and say, yeah, I know that the euro dollar is going up in my face right now, but I'll tell you, that's either a big ass flag pattern right there, or that it's a big flag pattern, working its way lower, or that's a big wedge moving lower. But all in all, we're moving lower and we're trending lower. So I don't have a problem if it goes up in my face a little bit while I'm trading it. Having that bigger picture viewpoint, or understanding the fundamentals, what are the drivers, it's key. It's interesting when I listen to some of these macro guys. Like, there's a lot of guys and gals out there that I think are too smart to trade. They really are. They think they can outsmart the market because they know all this, whatever. Randall said, and the pressure charts too. Okay, yeah. I also have to mention that when I'm looking at a pressure chart that is extremely strong, this is our Wise Trade these are our little algorithms that we use, that we've been using for a long time. When we have a strong pressure charts that are developing, those help me keep in a trade a lot longer too. But don't tell anybody, Randall. But I really think that some people are so smart that it hurts them. Like, people that have been shorting the US dollar Mexican peso for the last pesos higher, that say, well, fundamentally it doesn't make sense why I keep going up and I keep going up and I keep going up in my face. So, well, you have to, match it with technicals too. See, once you get a technical backdrop and a fundamental backdrop coinciding, that's when you got some power. That's when you got some power. Or being able to put multiple technicals together. Like, I'm not a big harmonics pattern guy. I'm not a big Elliott wave guy. But I rely on the analysis of some pretty good people to confirm what I'm doing. If I see a nice fractal developing in the market, which I don't really do fractals, but if I see a nice fractal developing, then that storyboard makes sense, and I'm shorting the euro, and that makes sense, and then the candles matched up there, and that makes sense, and the macro backdrop says it should be going down too, that makes sense, then it gives me that confidence to stay in a euro short, even if it's going up in my face a little bit. All right. So anyway, lot of good, lot of things I know are probably you're probably going through your mind right now, but hopefully some of this training helped. I don't train as much on the webinars as I probably should. When you've been doing this for so many years and you're talking about the markets and you're just answering questions about the now and what's happening, actionable items like, hey, the euro is bouncing right now, should I be buying it? You sometimes forget talking about some of these things, but oh shoot, I have a friend of mine that's calling me because I have to put privacy settings on an iPad, so stand by, please. Don't go anywhere, just give me a second. Sorry about that, guys. I have a friend of mine. He bought both of his kids. He bought both of his kids iPads for Christmas. And we did that a couple of years ago for our kids, and we set the security settings on them so they can only access certain websites, and it's really important because nowadays, especially if you've got like in his case, he's got a 4-year-old and an 8-year-old, 9-year-old. They're surfing around on the web, and they just click a couple of links, and get a couple of keywords that they shouldn't be, and next thing you know, they're seeing things that they shouldn't. And as a parent, I'm very sensitive to those types of things because one thing you can't undo? You can't undo something that they've seen. So if they click on a website, next thing you know, they see so whatever they're going to see, you can't undo that. That image is then forever grained in their head. You know what I'm saying? So I'm very much an advocate of making sure my kids don't see things they shouldn't see until it's an appropriate age, because you can't unsee it. You can't unsee it. So anyway, he's coming over here in a couple hours. I'm going to adjust all of his privacy settings and make sure that his kids don't get into any trouble that they shouldn't be into. All right. Anyway, going back into what we were talking about, as I go through these examples, if you have any questions or you have any comments, please feel free to ask or go through them, or and ask, and we'll go through them. I'm going to do that here in a few minutes. So let's take, this is the euro pound. I sent out a tweet yesterday, and if you guys remember the tweet, the euro pound was approaching 74 pence. All right. I myself was looking at the euro pound. We were about 73. We were starting at 73.50, 73.60 yesterday, and I started shorting the euro pound. Why did I short the euro pound? Well, this is a perfect example of knowing exactly where my risk was. Like, I was looking at this chart saying, okay, if I short the euro pound, I know that the risk is if we get a daily close above this yellow line, I need to get out, period, end of story. And then I was looking at the pound saying, okay, the pound dollar, okay, and you guys might have remembered seeing that tweet yesterday about the pound dollar, saying, oh, well, the pound dollar just came down to really key support, 127% extension, it should bounce. Well, if the pound dollar is going to bounce, then probably the euro pound is going to turn around too. And so I started shorting the euro pound. I shorted a little bit at like, I don't know, 60, shorted more at like 80, and I know I shorted more at like 74.05 yesterday. Okay, and when it got to 74.05, I had a really decent cost average. My cost average was about 73.80 or something going into today. And because I knew if it got above 74.25 and it stayed above there on a daily close, I would have to close out my position. So I was looking at that saying, all right, well, my risk is about 40 pips to make what? You know, in this case, I knew that we were going into Wednesday and into a holiday, so I figured, if we made it back down here to this congestion zone, I was risking 40 pips to make about 50, or excuse me, risking 35 pips actually with my cost average to make about 60, 65 pips, and that to me was worth taking the trade. Like I said, if it wasn't Christmas. If it wasn't the Christmas holiday, I would probably stay in the euro pound, because my 2 cents is if we break the 73 pence level, we're going to be seeing these levels again down here, especially for those of you that are still short. But that was another example of being able to say, all right, well, I'm risking a certain amount, like in this case is about 35 pips up here, if it got up to this area, but my reward was back down here to where the consolidation was, down here. And so once we got into that consolidation zone, I knew that it was time to take profits off the table. And we got there really quick. Now again, if I would have sat in this trade, or excuse me, if it wasn't Christmas, the Christmas holiday, and I didn't want to just scalp a little there, I probably would have stayed in this position, looking for more of a move down towards 72 cents, knowing that we hit a, low to high, here's a 24%, probably get down to this, the 618, maybe the 50% retracement. You're risking 40 pips to make, God, 150, maybe 200, right? So, anyway, it's that's just another example of what I did yesterday trading the euro pound, and hopefully you guys understand that it's all about making sure you have enough risk and making sure you have the potential to make a multiple of that risk. The best trades are when you can say, some of you are really efficient at entries, which is great. I know when I send out alerts, like for example yesterday when I sent out the euro pound rejecting the 74-cent level. I know a lot of you guys that trade this say, I'm waiting for Blake's alerts, and I'm just going to wait till he sends out an alert until I get in, because that's just extra confidence that I'm going to be looking for a short. Current at 73.95, and we have been as high as 74.16 today. The daily downtrend line is at, and so I've been talking all day about shorting the euro pound once we got to the 74-cent level, and I think the more disciplined you are for your entries, the better and easier it's going to be to have an appropriate limit to take advantage of. Well, let me see if I can take some of your questions that you've written in today. Joe says, hey Blake, I want to thank you for all your expertise and patience. My trading has improved so much since I accidentally found you on Twitter. Thank you. Have the most wonderful, well-deserved holiday. Thank you, Joe. And Joe's in Canada, so thank you, Joe. I appreciate that. And I know you've been a normal listener at least for the last 2 or 3 months, because you've been writing in since then, and I'm really glad to have you here too. I love interactions, especially with those of you that communicate with me on a daily basis. I know that means you're listening in, that you're engaged, and so I appreciate you very much. Thank you, Joe. Merry Christmas to you. Happy New Year. Let's see. Dan says it's all about risk reward. It is. And James says, what a jump on the pound Swiss. Wow. Yeah, the pound Swiss got a nice little pop today, which is nice. I know this has nothing to do with what we're talking about at the moment, but he just was pointing out that the pound Swiss has a nice recovery. Had a nice recovery from that horizontal support that we wrote down yesterday, so hopefully that'll stick in there. Uh, Carrie says, Blake, could you please go over where a stop needs to be and how much risk taken in order to make those 35% returns per trade I keep hearing about? Thanks. Well, first of all, if somebody's making 35% in a trade, I'm going to tell you right now, if they made 35% return on a trade, they are over leveraging their account. There's no if, and, or buts about it. Or they got really friggin' lucky. Like you shorted the euro 160 and you covered it when it hit parity. I mean, you, in order to make a 35% return in your account, you have to understand that you are risking 35% of your account at some point, if not more. So whenever you come across somebody who's like, oh, I made 35% in this trade, yeah, you probably need to run the other direction as fast as you can, period. Um, Randall said that was pretty good, Blake. Hey, you like that training? Like a little impromptu training? Well, you guys didn't even know it was coming. Merry Christmas, dang it. Um, Alan says, because it involves money, it's hard to say goodbye to the loss. It always is, and it is especially for a new trader. I think new traders have, I've found in my experience, women make really good traders because they can accept the fact that they can, they'll have to take losses. They're not as egocentric as most males are. So for males and for men, when you trade, the learning process to understanding that losses are a part of trading and you have to take them. They are a normal part of it. I think it takes a little bit longer for it to resonate with a lot of men traders. But once you got it down, you got it down. But I'm just saying that I think that's one of the, especially in the beginning years, those are one of the benefits to being a female trader that I've seen over the years. See, Dan says, actually coming here 6 months ago to the webinars have helped me. When I asked you about trades and you would see what I was seeing. Yeah, I think that helps too, and that's why you guys should never hesitate. If you're in a position, you're in a trade, you're long or short something, and you are, curious, like, hey, I'm in this trade, I'm long or short, I'm making money or I'm losing money, whatever the case is, have me look at it. I don't give you a recommendation like you should buy it or you should sell it because look, I don't know your situation. I don't know how big of an account you have. I don't have the proper, and I don't even have the license anymore, not since '97. I can't really give you a recommendation to buy or sell, but I can tell you, hey, you're long the dollar yen. Well, if I was long the dollar yen, I'd be a little nervous if it breached this area, because if it breached this area, it would, signal to me that there's probably more losses to come, and you would go, oh, well, that makes sense. I got long over here, and if it breaks over here, then I might lose X amount, and that trade, I don't feel comfortable being in that trade anymore. And going through that analysis process with me, I hope helps, and it obviously, Dan says it helps for him too. So remember, if you're ever in a position you want me to take a look at it, I can't tell you should be buying or selling, but I can say, if it was me, and if I was in this position, I'd be, looking at, this level as being a level of interest to take profits, and this level would be a little scary if you're long or short, and we can go through it, one by one. And I love doing that because it helps me, helps me find a lot of great opportunities. You guys know that I think some of my best opportunities that I find as a trader are for you guys, not because I found them myself. Scott writes in, Blake, thanks so much. I'm an experienced, successful trader, but hearing this stuff over and over again refreshes my views of my trading, and it instills more confidence in my trading. Thanks again. You're welcome, Scott. And the problem with it being experienced and being successful in the markets is the same problems that you have are the same problems that myself or anybody else that's been in the markets for a long time has. You know what happens quite a bit is you become overconfident, and you tend to forget your rules, and then you tend to overstep your boundaries, and that's when the market usually, whips you into shape. And that, it happens to me too. I get confident, cocky. I stop um, forgetting the rules. I stop thinking about risk reward. I start thinking about, hey, I can take a trade right here, and I can make money because I know exactly where the market's going, not accompanying, not taking into account where my risk and reward is, or where my limits will be, and where my stops will be, and then I usually get run over by a freight train by the market, and that is typical for those of us that have been doing it for a long time. So it's good, we get these refreshers from time to time, and it's great for me to talk about it too, because then I start to think about, okay, where is my risk? I'm going long the euro dollar. Where is that risk now? Um, Ron says being too smart. I don't have that issue. Well, at least you could admit that, Ron. I don't think a lot of people can. I know I'm not too smart. I know I'm not the brightest bulb in the bunch. That's for sure. But hey, look. I know how to assess risk, and because I know that's my job, I'm a risk assessor. I'm not here to figure out, who the next, ECB president is going to be and what his influence is going to be over the markets. My job is to basically identify the trends, understand the macro backdrop to a certain extent, and know where my risk is and where my reward is. It's really not much more complicated than that. I know it sounds simple, but it does take some time to garner those skills. All right, hey, I'll be back in just a few minutes. When I come back, I'll continue on with the questions. Thanks, everybody, for being here. Be right back. Hey, traders, this is Blake Morrow. You were listening to the Lunch Money webinar. I want to welcome you all back, and I'm going to continue on with questions. So thanks, everybody, for writing in. Here, this is a question from Eric. He says, so how do you decide where it's appropriate to take profits? I missed a little, and if I missed that part, don't worry about it. Work forced me to stay late. I ignored most of the vendor chat to pay attention to the webinar. Oh, okay. So how do you decide where it's appropriate to take profit? If you struggle with, and I know we've talked about this often, Eric, but if you struggle to know exactly where to take profits, the best thing you can do is take part of your position off the table. Take half, in my opinion, because when you take profits, it relieves two things: fear and greed. When you take half your profits, it removes the greed factor of, oh, I got to make money, because you did lock in a profit, so you can quelch that desire. Also, if you get out of your, or you get out of half, it removes the fear factor of actually losing, in the trade too, because you've already, actually captured a bit of a profit. So, in my opinion, taking half off, if you're ever in a situation where you're like, oh, I just don't know where to take profits, that's the first thing you do, because it actually helps you become more at ease when you're trading. So, like if you go to the euro dollar and you go, okay, well, I closed out half of my position, now I can ride the rest out. So now you have, your stop at break even, you've got the rest riding out, and then you can start targeting. You can say, okay, well, I had a low, high, and then I can start targeting the longer term extensions and stay in that trade a little longer. But other times you got to take in other things too, like when is it appropriate time to take a profit? Well, if you're coming into a news event that could greatly affect your position, like there's an interest rate decision coming up, or maybe CPI data is being released, and that might affect the trade that you're doing, or that there's a jobs report coming the next morning, and you're not going to be awake for it. So that might also influence your decision making, or you see some sort of technical area that's coming into play, like in this case, all right, well, I'm trading the euro dollar and we're coming into a trend line. So I know that we're coming into a trend line. I know there's a fib level there. I feel that based on my entry and how long I've been in the trade, it's a decent place to take profit. So, those are all things that have to be considered. It's not, as much as we'd love for it to just be so black and white, it's not black and white. If it was black and white, everybody would do it. If ever, that's why you have to take in. There's several different inputs as you're trading the markets that you have to take in, to make those decisions, and you have to weigh the pros and cons. So I always love it when random cars pull up to my office. Great. Okay. But Eric, thanks for writing in. Randall said, Blake, this is good training for newbies and oldies. Thank you very much. James asks, is the U.S. dollar Canadian good long here? Well, James, I already beat you to the punch. So why do you think the U.S. dollar Canadian is a good long at these levels? Because it's the support we wrote down, right? 138.50, and we're in a bullish trend. So do you think it's a good long, good place to be long here? I do. I think it is. Looking for a bounce. Linda says, hats off to you, great dad and neighbor. Oh, thank you, Linda. Dan says, Blake, I still struggle with letting winners run. I did get almost 600 pips on the pound yen, but the whole time itching to close it out. How do you get past that? I think the way you get past it, Dan, is in my opinion, it's always about size. In the markets, size does matter. I know, in other things, maybe size doesn't matter, so at least you like to tell yourself that, or maybe your spouse that. But in currency markets, or in the markets in general, size does matter. Because if you are trading an appropriate size, you don't get enticed into, is this appropriate stop? Is this appropriate limit? How, I should be taking profits right now. I don't even think about, like, my gains. My gains are easiest to deal with. Like, I'm sitting in my pound yen. After additions, I still have a 407 pip gain. But I'm also in several other trades, and they're all, relatively small. You lump them all together. If I took a loss on everything on my board, it'd probably hurt a little bit. But it's like, okay, well, I've got a 406 pip gain in the pound yen. I'm going to sit in it because I'm not worried about. I'm not worried. It's not like I'm watching every tick, because every tick is worth a 1/4%. So I just I go look at the charts and say, okay, the charts are still good. We've broken down. We've clipped some key support at 180, and we're staying below it. I can hold on to it. So just as much as when you're trading and you're in a loss, okay, you're in a loss, and you're managing that trade, and you're not freaked out because it's a small enough position. Is the same thing as when you're in a in a gain, and you're sitting in a gain, and you're sitting comfortably in a gain. All right, I don't worry about them so much as long as they're manageable size positions. So it may be a case, Dan, of maybe your position sizes are still a little too big. You might think they're good sizes, but maybe they are still a little too big. Eric says, where did the 35 pip risk come in? I didn't see that, where the number came from. Oh, so we were looking at the euro dollar. Okay, when you go euro dollar, and we were trading it up at the 109 like 70, when we were talking about 109.70, like your risk is 109.70, maybe above 110, maybe by a few pips, you got a 35, maybe 40 pip risk. Now your stop may be 100 pips away, but realistically, by the time you get out, you're thinking, okay, if I have to get out here, I'm going to end up taking a 35 pip, 40 pip loss. Greg asks, Blake, could you chat about sentiment behind wedges, triangles, etc.? I can recognize and trade them, referring stops, entries, etc. Just do it by rote, but not quite sure why. Thank you. You bet. So the other day, was it yesterday? We were looking at the E-mini futures, and we were looking at the futures. We were looking at this chart, and we were looking at the E-minis yesterday, and we were talking about this wedge that was developing, right? The sentiment behind a wedge is really interesting because wedge patterns. Well, traders are all the same. First of all, let me just start by saying that traders all think the same way. What do most traders think? Oh, it's at a resistance, I'm going to short it. Or, it's at a support, I'm going to go long. Most traders trade that way. And in this case, like the E-mini futures were knocking its head up against resistance, what happens there? Well, every time it hits resistance, more people short, right? They short, they short, they short. Every time they short, they try to short it, make a little bit of gain on the way down. What happens is those gains get smaller and smaller and smaller and smaller. And so what happens is you get short, you get people trying to target down here, they'll put their stops above the highs. Then you'll hit it again, they'll short, they'll put stops above the highs, and they might be targeting down at the support, but they never get hit. And so what happens is you get more and more people shorting the euro or in this case the futures, as it's rallying into resistance, and then all those stops start building above those highs. And then finally, because the highs are all equal, the stops are all generally in the same vicinity, what happens is when you finally break through that resistance, you trip a bunch of stops, you get everybody short, then you get all the speculators, or maybe people like you and I that are more looking as predators in the market, we look to get long. And so that momentum builds, and that's when you get the break higher, in the markets. R. Strong says, thanks for the educational info. It's appreciated. Have a great Christmas. You too. Andres says, did you see the FXCM winner for the last month? They are making 206% in a month in return. You know what that is, Andres? The only way you're going to do that is being over leveraged. That's it. There's no way. No way. You're just over leveraging your account. And if you do that, you have a one-way ticket out of this business eventually. And it will happen. It will happen. Mark my words. Lynette says, I'm doing a happy dance if I can make 0.5% in a trade over several days. Of course, because that's longevity. That's how you stay in the markets for a long time. Benedict says, hey Blake, I have some things to finish up at work before I take off for the rest of the year, but just wanted to wish you and your family a very Merry Christmas. You're awesome, and I'll catch you next week. Awesome, Benedict. You too, Merry Christmas to you, and thank you once again for the terracotta warriors. They guard a lot of our family pictures in our home. Fred says, good morning, Blake. Happy holidays and best wishes for you this new year. Thank you for your time and attention to help me improve my trading skills. You're welcome, Fred. Thank you very much for being here. Lorraine says, women do better on pullbacks, I think, because we're getting it on sale. That's a good one, Lorraine. Cindy says, Blake, I don't ever hear you talk about how many currency pairs one should trade. I find that working with a limit of 14 certain pairs help me watch and make enough pips. What do you think? I think that depends on experience. Like, Eric, for example, so I'm using him as an example today since we're talking about training. I told him, hey, you should be limiting yourself to 3 pairs, 4 pairs. And the other traders in our chat room were saying the same thing. It's like, yeah, once you become more experienced, like I trade anything. I don't care. I think they all move and act pretty much the same. You just have to understand what you're dealing with as far as pip values go. And, obviously the macro backdrop behind whatever it is you're trading. Like, that's why I'd stay away from some of the emerging market currencies. But technically they tend to act all the same to a certain extent. But that's also speaking from experience. The newer you are, the less you should be trading. A lot of newer traders, I tell them, like, if you can't count the number, if you can't count the number of trades that you have on one hand, then you probably are trading way too many currency pairs, in my opinion. especially for a lot of newbies. Gene says, Blake, thank you, and that was an unexpected, valuable Christmas gift lesson on understanding risk and how to use it appropriately when trading. Thanks. Have a Merry Christmas and Happy Holiday. Same to you, Gene. Tico says, hey, Blake, Merry Christmas and wish you happy holidays. Do you think the New Zealand-Canadian weekly reached a triple top and hammered? It's a good area for some shorts. You know, actually, let's take a good look at it because I would not mind being on the short side of this. I wanted to reach a little bit further, but it looks pretty ugly, doesn't it? I think you could probably short here with stops above, somewhere above 95, maybe even 96 cents, and target back at 90. It's a decent risk reward to be on the short side. I might actually short that here in the next 24 hours. Thank you for bringing that up. I like it. Hey guys, I missed a few comments, but it's Christmas, and you guys have been wonderful. I want to wish you a Merry Christmas. I will not be back until Thursday of next week. I will not. But I have really good guys covering with Steve Bealby and Paul Franco, so make sure you're listening into the Morning Edge Monday morning at 7 a.m. Eastern and European Crossover at 6 a.m. Eastern. You guys have a wonderful holiday. Merry Christmas to all of you. I appreciate each and every one of you, and I will see you before the new year. So have a great Christmas. And if you don't celebrate Christmas, enjoy